Ladies and gentlemen, good day and welcome to Himatsingka Seide Limited Q4 FY21 earnings conference call hosted by Batlivala and Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Prerna Junjunwala from Batlivala and Karani Securities India Private Limited. Thank you and over to you, ma'am.
Thank you, Stephen. Good evening, everyone. On B&K Securities, I would like to welcome you all for 2Q FY21 post results for 4Q FY21 and full year FY21 post results conference call of Himatsingka Seide Limited. From the company, we have with us the senior management, including Mr. Shrikant Himatsingka, Managing Director and CEO, Mr. KP Rangraj, President Finance and Group CFO, and Mr. Dilip Panjwani, Senior Vice President and CFO Strategic Finance. I would now like to hand over the call to Mr. KP Rangraj for the initial comments. Thank you and over to you, sir.
Thank you, Prerna. Good afternoon, good evening, ladies and gentlemen. I hope you and your families are staying safe and doing fine. On behalf of the company, we would like to welcome you to this earnings call for Q4 FY21 and the full year FY21 results. As always, I will start off with a business update, followed by an update on the consolidated financial statements, and which will also take you through the deck profile of the company. And after that, I will hand you over to the Q&A session to our Managing Director and CEO, Mr. Shrikant Himatsingka. I'll now start off with a business update. As you're all aware, FY21 has been one of the most challenging fiscals to navigate. While we were severely impacted during FY21 on account of the lockdowns, COVID-19-led disruptions, regulatory uncertainty, and raw material inflation, we were pleased with our operating performance during H2 FY21 on account of better capacity utilizations and order books. The demand for home textile products continues to be strong across segments and markets. We see a strong order book for FY22. The capacity utilization levels at our bedding and terry towel facilities increased in the quarter ended March and expected to continue to improve in FY22 on the back of strong order books. The capacity utilization levels for our manufacturing facilities during Q4 FY21 is as follows. Sheeting division clocked 76% capacity utilization in Q4 versus 71% capacity utilization in Q3. Terry towel division clocked 63% capacity utilization in Q4 versus 45% capacity utilization in the quarter ended December 20. The spinning division continued with 101% capacity utilization and pretty much the same in Q3. During the quarter, revenue streams from brands stood at rupees 565 crores versus 385 crores during the quarter Q4 FY20, the previous year, and 551 crores during the previous quarter. I will now move on to an update on the consolidated financial performance for the quarter ended March 21. The consolidated total income for the Q4 FY21 stood at 748.04 crores versus rupees 471.40 crores in Q4 FY20, the previous year, an increase of 58.7% on a year-on-year basis, and versus rupees 681.65 crores in the previous quarter, which translates to an increase of 9.7% quarter-on-quarter. This growth was driven by the enhanced capacity utilizations at the sheeting and the terry towel facilities. However, please note the financial results for the quarter Q4 FY21 does not include any recognition of export incentives under the RODTEP scheme, which is effective from 1st of January 2021, as the rates for the same are yet to be notified. The RODTEP scheme, as you are all aware, has replaced the ROSCTL and MEIS schemes for export incentives. Therefore, Q4 FY21 consolidated revenues and operating performance are not comparable to the other quarters in the light of the above. Consolidated EBITDA for Q4 FY21 was rupees 129.66 crores versus rupees 96.60 crores in the Q4 FY20, which is the previous year, an increase of 34.2%. EBITDA margin stood at 17.3% in Q4 FY21 compared to 20.5% in the previous year. The consolidated PAT for Q4 FY21 was rupees 37.57 crores versus a loss of rupees 68.84 crores in the previous year. So I'll now move on to the yearly financial performance on the consolidated financial results. Consolidated total income for FY21 stood at rupees 2,272.53 crores versus rupees 2,419.65 crores in the previous year, which is a decline of 6.08%. The consolidated total income and operating performance have been impacted for FY21 on account of the following. 1. Lockdown restrictions imposed during the first quarter of the fiscal. Number 2. Major COVID-led disruptions between Q2 FY21. And as already explained earlier, Q4 revenues have been impacted on account of the non-recognition of export incentives under the RODTEP scheme, as the rates of the same are yet to be notified. The last point is the inflation in raw material prices and imposition of import duty and levies on raw cotton. Consolidated EBITDA for FY21 stood at rupees 303.17 crores versus rupees 479.31 crores in the previous year, which is a decline of 36.7%. EBITDA margin was 13.3% as compared to 19.8% in the previous year. The consolidated PAT for the full year ended March 21 stood at a loss of rupees 53.35 crores versus a profit of rupees 13.25 crores in the previous fiscal. I now move on to the debt profile. The consolidated gross debt as of 31st of March 21 stood at rupees 2,467 crores compared to rupees 2,814 crores at the end of the previous fiscal, which translates to a reduction of rupees 348 crores. The total term debt stood at rupees 1,613 crores and the total working capital debt stood at rupees 836 crores. The cash and cash equivalents stood at rupees 144 crores at the end of March 21.
Mr. Rangraj?
Hello?
Yes, sir, we can hear you. Please proceed.
We continue to be focused on deleveraging our balance sheet going forward. With this, I would like to complete my update. We will be happy to take on your questions now. I would now request our Managing Director, Mr. Srikanth Himatsingka, to address the Q&A session. Thank you and over to you, sir.
Thank you very much, Ranga.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and one now. The first question is from the line of A.M. Lodha from Sanmati Consultant. Please go ahead.
Hello, this is Himatsingka. Hello.
Sir,
Hello?
can you take the phone off speaker, please? Your voice is not clearly audible.
Hello, now it is audible, sir?
Yeah, please go ahead.
My first question is, sir, just I wanted to know whether the company is fully integrated for its yarn requirement.
It's partially integrated for its yarn requirement, and we partially buy our requirements from third parties.
How much, sir? Can you tell me the percentage-wise?
Our internal capacities are adequate for approximately, is approximately 35 to 40% of our requirements at this moment.
35 to 40% you are buying from the market.
35 to 40% is what we produce internally by weight. The rest we buy from
Remaining you are procuring from the market.
That's
right. Then my second question, sir, that what capacity this Teritol plant is running?
As stated by the group CFO, during the fourth quarter of the fiscal, it operated at a utilization level of 63%, sir.
The last question, sir, are we planning for the capacity expansion of the sheeting and the Teritol brownfield?
Yeah,
balancing equipment, by putting the balancing equipment, sir?
Yes, we have the ability to debottleneck our facilities and enhance our capacities organically as and when the need arises. So sheeting can expand further at very marginal capital expenditure requirements, and so can Teritol. So while we are operating at 76% and 63% respectively, and we expect the utilization levels to continue to rise in this FY22. As we also said, we see pretty robust demand for our products during the next fiscal. Should the need arise, we will consider organic debottlenecking our capacities and enhance the same if required.
Okay, thank you very much, sir. I will rejoin Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you. The next question is from the line of Resham Jain from DSP Investment Managers. Please go ahead.
Yeah, thank you and good afternoon, team. So I have three questions. So first is this incentive. What was the impact if we assume quarter three numbers in terms of the incentive rates? What would have been the impact in quarter four in terms of rupees crores?
The exact number, Resham, would depend on certain product mix and things like that. But it would be in the region of 35 to 40 crores.
Okay. Understood, sir. So my second question on, generally we are seeing inflationary environment across raw material and also in terms of logistic costs and a lot of other things. And at the same time, we are seeing good demand and better utilization levels. So is there any trade-off between these two going into FY22? Some of these inflationary headwinds can be mitigated by better utilization, operating leverage. If you can just share your thoughts around this.
Yeah. So other than RODEP, the Q4 has also been impacted by raw material inflation, both at the raw cotton level and at yarn levels, along with other raw material inputs that are used along the value chain. It's not normal to see these levels of inflation. Of course, on a weighted average basis, a lot of it was absorbed, but the inflation has been present starting the middle of Q3, and growth will help obviously offset the impacts of inflation, as will superior product mix, price increases, and I think all these three factors acting in confluence will help mitigate the impact. In addition, at some point, the inflationary movements have to abate and correct. So I think all these four pieces put together will make sure that things are handled in terms of managing the impact of inflation. There could be some timing difference between quarters in handling the inflation, but directionally, I think there should not be a material issue. And since growth is one of the important factors that will make sure that the inflation is dealt with, the strong order books help that cause. And so I think we remain reasonably confident of addressing a substantial portion of the inflationary impact going forward.
Understood, sir. And so my last and the final question is on, you mentioned about very good order book in FY22. Any number if you can share, broad range in terms of what kind of growth, because FY20 also got impacted. FY19 we saw our peak revenue, and on that base, what kind of broad range of growth should one expect in FY22? Yeah, that's it from my side.
Well, that's a tough one, Rishan, because we don't give guidances. But under the circumstances, it's fair that we drive a little more clarity as to what one could expect. So when we use the term strong order books, we see them to be buoyant, not only because of the enhanced demand for soft home products, but also more specifically because of the various new products that we've launched across our bedding and bath verticals, and they've seen a good reception across markets. So I think both the factors, that is, general demand for soft home products, as well as more specifically our efforts in furthering our market share, both these factors will act in confluence to make sure revenues sort of go north. Now, coming to how much north, obviously we wouldn't like to put a finger on it, but it will be safe to assume two things. A, it will progressively increase during the fiscal 22, and B, we should be doing better than annualized run rates of Q4.
Okay, got it, sir. Thank you very much. This is very helpful.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Raj Nahar from Money Consultant. Please go ahead.
Good afternoon. My question is regarding the yarn capacity. As you mentioned, it is 35 to 40%. So currently, the yarn market has been very strong. And whether are you able to, first is that to buy the required quantity, and whether we are able to pass the increased cost of yarn. And second, is there any thought process on enhancing the spinning capacity more?
Right.
That is my question.
Rajji, if I may answer both of your questions.
Yep.
There is no issue on the supply of yarn as such. So while there are supply chain disruptions, interstate movements are hampered from time to time, and inward logistics are hampered for imported cotton and things like that. There are supply chain disruptions, but those are being handled as and we've made sure that there's no material disruption to the business at this point. So supply chain disruptions exist, but the supplies very much continue. So that is to your question about are we able to procure the required yarn under the circumstances? Yes. The answer is yes. The second part of your question is, so how do we plan to mitigate the yarn price increases? Yes. And the answer to that is the company will have a 3 to 4 pronged approach. There will be the growth in revenues that will help us mitigate some of this impact. There will be some price increases, superior product mix, amongst the 3 most important parts are pieces that will help address this issue. We are also realigning our supply chains to be able to mitigate some of these impacts. However, we don't see any increase in spinning capacity in the near future to mitigate this impact. We will contemplate enhancing spinning capacities given our large captive consumptions going forward, but nothing in the near future.
Oh, okay, sir. Thank you.
Yes.
That's my
Thank you, Raji. Thank you.
Thank you.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hello. Hi, sir. Just one question from my side. Could you please share an outlook for the EBITDA margins going ahead in FY22 given this increase in raw material prices?
It's a difficult one, Rishi, but I think our normal EBITDA percentages are somewhere in the range of 20 to 22%, in that range. I think we will see a little correction in those margins, for the full year, given the inflationary impacts. But we should be able to keep them range bound with a progressively better performance during the entire fiscal. So, in other words, in the near term, there could be the impact could be slightly exaggerated. But as our price increases kick in and the inflation settles down, progressively we will catch up with the margins, and as a whole, maybe we should be closer to the lower end of the band, than we normally achieve.
Okay. Okay, sir. Thank you very much.
Thank you. Before we take the next question, a reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Devang Patel from NAFA Asset Management. Please go ahead.
Hi, sir. If I look at the difference between the Concall and the standalone numbers, at the PBT level this quarter, the number has turned from negative to positive. Could you explain what has changed and if this is sustainable?
Yeah, great question. We've been attempting to better manage our global sort of value chain and balance it a little better. So this is a result of that. Maybe don't go exactly by this quarter, but you are right. The balancing between standalone and Concall will be better than is normally the case. So directionally, this is here to stay. The quantum might decrease a little to balance it out. But yes, directionally, this is where we are headed to better manage our value chain. But I would urge you only to look at the Concall numbers and not the standalone and Concall separately.
Okay. Sir, and on the debottlenecking in the next phase, how much time would it take to debottleneck, and when would you consider that decision?
We can debottleneck our capacities in 6 months from when we hit the button, as I said. We will watch this demand pattern for the near term and then take our call.
Right, sir.
Since we have some capacities in hand, we'll wait for a little more time. But post that, if this continues, as I said, for very marginal organic capital expenditure, we will debottleneck our capacities.
So you would consider that sometime later this year?
I think it's a good time to revisit the question, at the end of the next quarter or so, or first half rather.
That's all from my side, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Viva Batra from Fair Connect. Please go ahead.
Yeah, my question is again on top line growth. So FY21 was exceptionally lower. So the base itself is low. So if you were to just calculate, as you said, on quarterly, you will expect similar growth trend. Can we expect 25 to 30% growth on an annual basis for this financial year?
As I said, ma'am, we hope to do better than the annualized run rate of Q4. It might unfold progressively during the fiscal, but as a fiscal as a whole, that's what we plan to achieve. I mean, that's where we are headed towards, subject to, of course, any extremities and unforeseen circumstances that might come our way on account of COVID or the third wave or things like that. That apart, this is where we seem to be headed.
So in percentage terms, I calculate, for example, March 21 growth over December 20 and then impute the percentages, or year on year?
No, just look at the Q4 FY21, and as I said, we hope to do better than the annualized run rate of Q4 FY21.
Okay.
So,
fair enough. Okay. So then also we are expecting our operating...
Although I like to remind everyone that I did use the term progressively, so there could be timing differences between quarters, but as a whole fiscal, that's where we're headed.
Fair enough. And where do we see our return on capital employed, say, it's in single digits, if you were to see now, and we are at...
So obviously FY21, ma'am, is not the right to judge our capital efficiency. But our stated, we'd like to achieve capital efficiencies in the region of, 17-18%. Ideally is what we target. Once our model stabilizes, please note that our Perital plant is a new facility. We've been ramping it up through these rather challenging times. And unfortunately, we've faced the regulatory uncertainty that you all are aware of, along with unprecedented levels of inflation. So that doesn't help in our model settling down. But we've taken the mitigation measures as outlined, and hopefully with that, directionally we'll continue to improve our ROCEs. I'd also like to say that the return on capital employed not only should be adjusted for payables, but I don't know how most analysts look at it, but because of the change in accounting standards, there are two buckets that have enhanced the size of the balance sheet, not just for us, but any company that has the following. Any duty benefits availed of in the purchase of imported machinery will now be sitting in your balance sheet as government grants, and the second change has come through in the form of the right to use of lease liabilities that sit on the balance sheet as well. The reason I'm pointing this out is that it depresses the ROCE number because of the fact that it sits in the denominator. So I don't know how most houses are dealing with it, but this is a result of an accounting standard change that has been introduced probably a year ago or something of that nature. And as far as our balance sheet is concerned, it has inflated or enhanced, not inflated is the wrong number, it's enhanced the balance sheet capital employed by over 400 crores. Because
400 crores on account of government grant?
And right of use, which you will see
right of use is fair to be included in the capital to compute the ROCE, but that's a different subject altogether. So I guess if you can
right. So whether it's fair or unfair is a separate subject. The reason I'm bringing it to your notice is that it's different and a departure from what existed. And therefore, I don't know how you'd like to compute it. But I'm just bringing this to your attention in context to it having a depressive influence on the number.
I appreciate this. And in this incentive, how long will it take in your estimate for government to finalize it?
Ma'am, unfortunately, I have no clarity on the subject other than what any of you read in the media. So per media statements, the government should be announcing it shortly, but whether they do or not remains to be seen.
Okay. So then you will have an exceptional gain also for January to March quarter, and whatever is going forward, that will reflect in your numbers whenever it comes.
Per their current view, and that's how it should be. Do keep in mind that the inflation will also be very heightened during this time, probably more than Q1, because by the time price increases kick in and so on, we are already in the end of May. So, so while you'll have some exceptional gains, you might have some enhanced impacts on account of these factors as well.
Sure. Okay. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Prerna Jhunjhunwala from B&K Securities. Please go ahead. Ms. Jhunjhunwala, your line is in talk mode. Kindly go ahead with your question, please.
Yeah, am I audible now?
Yes, ma'am, you are.
Yeah.
Hi. Okay. Hello, sir. Congratulations on a good set of numbers.
Thank you.
So, you in your earlier comments, you mentioned that FY22 is going to experience superior product mix. So, could you please enhance on that comment? What kind of changes you're seeing on the demand perspective, as well as in what context we can see this happening in FY22?
Well, I mentioned it as, Himatsingka has had a superior product mix in its revenue streams. So that will help us mitigate some of the inflationary impact. What I didn't mean that our product mix will, improve further from here. I just meant that it's a good thing to have in our arsenal to be able to fight inflation. And superior product mix definition would also include the fact that, that a substantial part of our revenue streams do come from brands. So to that extent, we might, be helped in managing inflation. That's what I really meant.
Okay. Okay. And sir, with in the US, we're seeing good consumer demand coming in. Do we see the brand performing much better than low value products, which we saw in FY20 as an industry? FY21 as an industry, we saw demand for low products to be heightened due to pandemic times, etc. But going forward, do we see that brands will outperform again?
A lot of our brands are mass brands. In fact, they all are. And, it's good for us that the demand is broad-based. It's good for us that, it's good for us and in general as well, that it's not just the high-priced products that move, because a bulk of Himatsingka's products are, catering to broader audiences. So when I say superior product mix, that doesn't necessarily mean high-priced product mix. It can mean better priced, lower-end product as well. I think the demand pull is across price points, and is not focused just on the better or the lower price points. We see demand being strong across price points. So it's holistic, it's broad-based, which is good.
That sounds great. So that's really helpful. The second question is on debt. We've seen substantial improvement on your debt profile. What can we expect for FY22 and 23 going forward?
So, as we have shared with you earlier, our major capex has anyway been concluded. We are now on organic capex mode, and we will continue to be focused on deleveraging our balance sheet on the one hand and enhancing EBITDA on the other. So they will have a twin impact on our leverage ratios going forward. I think during FY22 you'll continue to see debt reducing. There could be timing differences between quarters, but as a financial year as a whole, you should see debt correct. I guess it would be safe to assume that we would expect correction of up to 200 crores or thereabouts.
Okay, that sounds interesting. And my last question would be on European Union. You had entered into a tie-up with Disney. Could you help us with any progress on the European Union traction?
Yes, we did forge an alliance with Disney for the distribution of soft home products in the EMEA region, the Europe, Middle East, and African regions. And we should see progress on that front in FY22 as well. It's an important addition to our brand portfolio. It helps broad base our reach. It strengthens our juvenile portfolio. And there's a lot of exciting things going on in that space as well. So we should see, so that should also be a contributor to the growth that we envisage during 22.
Okay. Thank you so much and all the best.
Thank you. Thank you, Prerna. Thank you.
Thank you. The next question is from the line of Anurag Jain from Green Lantern Capital. Please go ahead.
Thanks so much for this opportunity, and congratulations on a decent set of numbers in challenging times.
Thank you, Anurag.
So one question which I had was that with this China Plus strategy becoming more and more visible, and we at the same time over the last 3 years have significantly enhanced our gross block, and we are ready with our world-class capacities. So are we seeing significant increase in inquiries and more number of customers talking to us, and would we see significant traction on that front in the next couple of years?
I would imagine, So the traction, as we see it, Anurag, is being witnessed for the following reasons. A, Himatsingka has broad-based its product mix, with the launch of its new Terry-Towel plant, and has entered several sub-segments in both its sheeting and towel segments. And we are reaching out to a broader client audience globally, and that is giving us some mileage. So that's one reason that we're seeing growth. The second is, there's a general buoyancy of soft home products globally. And then there's a third piece, which is to do with, geopolitical reasons that are driving demand shifts and that's been witnessed over the last year or so. You're right in your observation that the intensity of the demand shifts, are more, let's just say, pronounced over the last few months. So it will, as we see it, it will be a contributor to the strong demand over the next few years that we are seeing. This will be one of the reasons that cause such movement. I would caution you though that these things can also reverse should there be issues with Indian supply chains of any material nature. These things can also reverse, but at this point we see it as a positive factor that will drive demand going forward.
Okay, got that. So one last question from my side. This was on the business model itself. So, right from spinning till the brands, we are present across the board in bed linen, sheetings, and the walls.
Yeah.
So the question. Hello. Am I audible?
It's in bedding and in bath products.
Yeah. So the question was, and I was going through the annual report, and we working with big brands and very high end cotton products and stuff like that. What I wanted to understand was, again, in terms of margins, in terms of resilience of the business, in terms of return ratios, being such a huge vertical integration. What are your thoughts there? Are we up to full potential of the business model that we built, or there's scope to improve margins, return ratios?
No, so let me give you a broad overview. Please don't hold me to specific numbers because assumptions change from time to time, and underlying sort of drivers change from time to time. But I think to your question of what is full potential vis-a-vis what our investments are and what we have made so far. There is a fair bit of upside for the seeds that we have sown thus far. We have capacities to be tapped in sheeting and in terry, and we have some organic debottlenecking that we will sort of put through as we closing on full capacities. There's also scope to enhance capacities beyond the debottlenecking at marginal capex rates. So I think our home textile solutions portfolio, has a fair amount of upside from here, both on top line and on the EBITDA front. And with continuing deleveraging focus, given the fact that we have completed our major capex, it will also automatically drive a focus on capital efficiencies. So someone just asked me the question about ROC. So I think we will look at trying to deliver 17-18% ROCs, ideally speaking, on the capital that we employ. And the industry is stable. There are entry barriers that exist. There are only three players with large integrated capacities in this field at this point. And so, it's not easy to set up capacities. It's time consuming and it's capital intensive, and so on. And so given those entry barriers, given the fact that there's a fair amount of upside that's still left, given the fact that we operate an entirely integrated model on a B2B basis, and Himatsingka truly has world-class assets. We have demonstrated the fact that we have led the pack, I would say in most years in terms of EBITDA profile, and things like that. So given all those things, there's a fair amount of fuel that is left on the table, and that's what we are now focused on sweating.
Okay. Got that. Thank you so much. All the best to you.
Thank you. Thank you very much.
Thank you. The next question is from the line of Pratiksha Daftare from Equitas Investment Consultancy. Please go ahead.
So just a couple of questions. If you could just tell us, that what are the key drivers for our growth expectation for the next year, or the order book that we have? That's my first question. And secondly, I wanted to understand that do we have any maintenance capex plan, and what will be the quantum?
So the drivers will be, let's just go through this from a standpoint of logical sequencing. The most important growth driver is the end consumer and the consumption that's sort of being witnessed across markets. So that's where it emanates from. That is robust at this point. The second important factor is that one must be well entrenched in global markets, which means our client reach must be strong, which exists, because that's required to tap into that consumption that's taking place at the point of sale. If these two factors are aligned, then you need the right products and brands to offer to these clients, who will in turn offer to the end consumer, which is also in line. We believe we have probably the best brand portfolio in the industry and a very, very versatile range of products, both in our sheeting vertical and in our towel vertical. Our spinning vertical is largely captive, as I said earlier, so that doesn't count. Himatsingka also leads the industry in traceability solutions in the cotton space, which is very important for the millennial consumer and new age retailers as they realign and relook at their offerings to audiences. Once we have the right offering and the brands and the right product versatility, what's important is global scale manufacturing capabilities and scale, which is something that we've put together over the last few years. And the fourth piece is focus on execution and the ability to actually execute this demand, which is something that's currently underway. The last few quarters has been volatile. There is no denying that. But if you look at our track record through 15, 16, 17, 18, 19, and probably the first half of FY20, we've consistently grown our top line and our EBITDAs during this period. The volatility that we witnessed was really during the second half of FY20, right through to the end of first half of FY21, and then we saw sort of coming back to stability during the second half of 21. So I think the worst period of volatility is over for Himatsingka. There could be some near-term pressures on inflation of raw material, but that won't disturb our model as such. And we are poised to now harness the benefits of the seeds we have sown over the years to realize true potential of our model and of our assets. So these are the growth drivers, ma'am, that will help, going forward. And I'm sorry, what was the second part of your question?
Maintenance capex, sir.
The maintenance capex, as we have shared earlier with stakeholders, probably in the range of 70, 80 crores, somewhere there. 60 to 80 crores in a year. Could be more in some years, could be less in some. That's where it would average out.
Okay.
So,
and just one last question. Yeah, you were saying something, sorry, sir.
So it works out to approximately 3% of net block and 2.5% of gross block.
Okay. And Okay. Just want to confirm this. You said that debt reduction target would be about 200 crores in FY22, right?
Yeah, approximately. That's right.
Okay.
Subject to volatility and unforeseen circumstances that might crop up during the year on account of COVID. I'd like to qualify it for that. So if there are such movements during the year that are extreme, these targets could change accordingly.
Got it, sir. Got it.
Right.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Srikanth Himatsingka for closing comments. Over to you, sir.
So thank you all so much for taking the time today. I hope I've been able to answer most of your queries and questions. We are available anytime to take you through more questions and queries. Should you have any, do feel free to reach out to us, and we'll make sure we've addressed your questions. Thank you very much again, and do stay safe. Bye.
Thank you. Ladies and gentlemen, on behalf of Batliwala and Karani Securities, that concludes this conference. We thank you all for joining us, and you may now disconnect.